Hello and welcome to the Market Mosaic. In this video, we'll take a look at macro data, market technicals, along with market internals to try to gauge where the stock market could be heading next. Later in this video, I'll also have a trade idea that I'm watching, and we'll break down the key levels to watch there. And if you find this video helpful, please hit the like button. Feel free to share this post with anyone that would benefit from it. Become a subscriber or follower if you have not already done so. So for this week's update, we're coming off a huge week for the S&P 500, finishing up more than 3%. The S&P has gained nearly 28% from the early April low. So if you go back and look at the intraday lows set in early April, the S&P has gained 28%. We had a number of catalysts working in our favor this past week. We had easing geopolitical tensions. There's some more optimism around trade negotiations and trade deals. And there's also growing hopes for interest rate cuts to the Federal Reserve. So first, let's just start with the easing geopolitical tensions. When we started the week last week, it looked like things were really set to escalate in the wrong direction after the U.S. joined strikes against Iran, hitting 3 of their nuclear facilities. Iran the next day retaliated with missile launches of their own aimed at a U.S. base in Qatar. But those strikes, they turned out to be more symbolic. They were flagged ahead of time. And soon after those strikes, there was a ceasefire and a pause in the hostilities announced a short while later. So that was the initial spark, so to speak. And investors also received some relief from uncertainty around tariffs and trade negotiations. So President Trump announced that a trade deal had been signed with China. Just recently, another White House official stated that there are more than 10 other deals that are imminent. And that's, again, a sigh of relief because right now, the effective tariff rate currently sits at 15.8%. Looking back, you can see that is the highest level since 1936. And this is important because this does not include the reciprocal tariffs that were announced that drove the market lower at the start of April. That 90-day pause is fast approaching, so that technically ends on July 9th. However, the White House did come out and signal some flexibility around that deadline. So we'll see if that deadline gets pushed back to allow some further progress on trade talks. Now, here's what this is also doing. Because of the potential impact of tariffs on the inflation outlook. So again, tariffs are running, the effective tariff rate already before anything reciprocal goes into place is running at the highest level since 1936. That has made the Federal Reserve cautious about adjusting rates lower because of the potential impact to inflation. But since we're starting to see some announcements with deals made or deals coming, there's some growing optimism that the Fed might be able to reduce rates by more than expected this year. So Fed officials in their last updates believe they are going to reduce rates with 2 quarter-point rate cuts this year. However, after last week, market implied odds, so what the market thinks, is now starting to shift to 3 quarter-point rate cuts this year. So I want to get into all these things just a little bit further. We'll go into some of the bullish conditions that are in place right now that can keep the rally in the S&P 500 intact here, at least over the near term. And we'll also look at evidence that inflation, despite some hopes that maybe the tariffs won't be as bad as expected, we're going to look at some evidence that inflation could be a problem second half of the year, despite the good news we've had recently here on the tariff front. So let's talk about the near-term outlook for the S&P 500. The index closing last week at an all-time record high at 6173 on the S&P 500. That surpassed the February 19th peak in the market. The index briefly fell into bear market territory on April 7th. So that means it only took 89 trading days for the S&P 500 to reach another new record high. That is the fastest recovery to new highs following a decline of at least 15% in history. And as unbelievable as it is that we're at new highs on the index, there could be more gains in store if you look at seasonality. And that is because historically, July has been one of the strongest calendar months of the year. July has seen a gain for 10 consecutive years in a row now. But if going back, you can see the past, this is since 1950, past 20 years, past 10 years, and how July evolves in post-election years. No matter how you want to look at it, July pretty much ranks in the top 1 or 2 spots for calendar month seasonality, again for the S&P 500. So seasonality remains a tailwind for investors. Another tailwind for investors could be bearish positioning. So despite the recovery in the S&P, despite the index right back to record highs, there's actually been an uptick in bearish moods, whether you look at sentiment or positioning data. So in the most recent update, the AAII survey of retail investors showed bearish views we're at 40, so bearish outlooks were at 40.3%. I compared to a percent of investors with bullish views at 35%. So bears are outnumbering the bulls despite the market at record highs. This is the second week in a row where the bears have outnumbered the bulls. And I'd also note that is the bearish views are well above the historical average of 31%. Now remember, sentiment works as a contrarian indicator where it pays to do the opposite, particularly at the extremes. We're not at an extreme for sure on bearish views, but it is worth noting that we definitely have not seen a swing back to extreme bullish views. There's just a lack of bullishness right now. But the other thing, that's what this chart on here highlights, is that so the AI sentiment survey asks investors how they feel. You also want to see how investors are betting with their own money, and that's what this shows. Bearish positioning is showing up in data tracking stock index futures. That positioning in S&P 500 futures, looking at a group that includes hedge funds and large speculators, that is showing a big increase in short exposure. So if you look at the number of contracts being shorted relative to open interest, that gives you this percentage. It's the largest short exposure that you've seen in this measure going since 2024. So seasonality, bearish sentiment, bearish positioning are all things that can help support the market here, at least over the near term. Now, there's one other catalyst that has been coming into play recently, and that is the outlook for rate cuts. That is all of a sudden becoming more of a positive catalyst, again, at least over the near term, with some things evolving since last week. Now, there's been a lot of debate on where rates should be at, especially following the Fed's last meeting. So Fed Chair Jerome Powell, he commented that they expect a meaningful amount of inflation to arrive in the coming months, but President Trump's been launching a series of verbal attacks on Powell, calling on the Fed to cut rates to as low as 1% because inflation's dropped back near the Fed's 2% inflation target. So the way this plays into the rate outlook, given the Fed's concern around tariffs, this recent good news on the trade front, that is increasing investor hopes that we could have more rate cuts this year than what was previously expected. So that's what this chart on here shows. This shows market implied odds for where the Fed funds rate is going to be at their last December meeting. And what you can see is that over 50% of market implied odds is in this range of 3.5% to 3.75% on the Fed funds rate, compared to their current target rate of 4.25% to 4.5%. So what that means is the market thinks that there is going to be at least 3 quarter-point rate cuts from now through the Fed's last meeting of the year, again, based on where probabilities currently stand. So keep an eye on these shifting probabilities as news comes in around the tariff and trade war front. But there's a reason why optimism around more rate cuts might be misplaced. So we had the Fed's preferred inflation gauge, the PCE, the Personal Consumption Expenditures Price Index. It rose 2.3% in May compared to last year. That's continuing a trend of disinflation since mid-2022. The CPI, the Consumer Price Index, a more widely followed inflation measure amongst investors, has been doing the same thing, moving lower. But the chart here shows that there could be an inflection higher in inflation along the way. So what this looks at, the orange line on here, this is the prices paid component from the ISM manufacturing survey. So what this ISM survey does is it goes out and asks purchasing managers at manufacturing organizations about trends in things like new orders, employment, while they ask about prices paid in two as a way to figure out where inflation trends could be headed. And this goes back to early 2020. You can see this prices paid component tends to inflect at the same time or even lead changes in headline CPI, which is the blue line on here. So this ISM prices paid peaked out well before you saw the peak in CPI inflation, while you've had a trend of really higher lows and higher highs. So you've had this prices paid component moving higher really since 2023, but you can see the jump, this big jump here recently again, foreshadowing that we could see a tick up higher in the consumer price index. And so that's one reason why, rising inflation could be an issue, especially in the second half of the year. It's also noteworthy that you're having commodities rallying here at the same time, which could be another inflationary catalyst again in the second half of the year. Now, there's one other reason why Fed officials may be reluctant to cut interest rates aside from uncertainty over the inflation outlook, but it's because the current level of Fed funds, it seems like the economy is holding up despite the high level of Fed funds thus far. Now, we had the final report on first quarter GDP last week showing an annualized decline of 0.5%. But that decline, it was driven largely by a really large surge in imports ahead of expected tariffs, again, back in the first quarter. So a rise in imports counts against GDP, the way GDP is calculated. There's one thing you should look at when you're looking at the GDP report, and it's something called final sales. You want to look at real final sales to private domestic purchasers. Now, I know it sounds like a mouthful, but that is a better way to get past some of the noise in the GDP calculation that can be caused by things like imports or changes in inventories. And you can see, we had the 0.5% decline in GDP while this real final sales figure came in at 1.9%. Yes, that is a deceleration from prior quarters, but you can see it's within the range that we've had really going back to 2023. So not seeing, so far, you haven't seen initial jobless claims tick meaningfully higher. You haven't seen payrolls data deteriorate yet. You're also seeing this GDP figure holding up here as well, which again is another reason why the Fed may be reluctant to cut interest rates right here. All right, get ready for a big week ahead. So we have a holiday shortened week here in the US with the 4th of July, but that is not going to stop the economic reports from coming in. A couple of the big ones that I'm going to be keeping an eye on. We just talked about the prices paid in the manufacturing ISM. We'll get an updated look at that for the month of June here this week on Tuesday. Also on Tuesday, we'll receive comments from Fed Chair Powell. It'll be interesting to see what he says after all this recent criticism coming out from the White House, and if he's going to change his tone and views towards inflation now that you're starting to see some more progress on the trade front. But then also this week, the other big event to keep in mind is the non-farm payrolls report. So we're going to get the jobs report for the month of June. That's going to come out on Thursday. Usually that'd be released on Friday, but we'll have the holiday. So that's coming out on Thursday in what is likely to be a very light volume trading day. So this, could exacerbate swings in either direction. Right now, the consensus is for 120,000 jobs added during the month, with a slight uptick in the unemployment rate to 4.3%. Last thing I want to leave you with today is just to take a quick look at a trade idea, a name that I am following, and this is with Trane Technologies, ticker TT. This company operates in the HVAC space, so heating and cooling systems, which may not sound like a very sexy industry to be in given the hype around other things right now. But I like to look at this company as a pick and shovels play on the AI theme, on the artificial intelligence build out. That's because in order to run AI applications, you're seeing this massive investment in data centers. And while those data centers have big time cooling needs, and that's another large source of demand for HVAC equipment, which is why I wanted to keep an eye on Trane Technologies right here. So let's just break down this chart really quick and what I'm looking at. So the stock originally peaked out around this 420 level back in November, and then went on to pull back. We had the market pull back and drop into early April. The stock found its bottom in early April as well. Now here's where the setup gets interesting. We had a quick rally that took the stock out to a new high, so took it past this 420 level. But here's when I like to look for something I call a base on base pattern. That's when you have a breakout over a resistance level, comes back to test that level of support as we're doing right here, and trades in a tight range. So we're coming back, we're back testing this 420 level that was the prior high for November. We're trading in a really narrow range. We're getting momentum worked off in doing so. This MACD, this looks at how the distance between a short-term and a long-term moving average. As just a way of gauging if a trend is extended or could be ready to renew. So we've got this reset above the zero line. Keep an eye on the relative strength ratio, so the ratio of Trane stock price to the S&P 500. Like to see that confirming at new highs. That shows there's good momentum behind the name. And the last sign I'll look for, so I'm looking for a move over 440 now. So 440's become your resistance level here. Look for a jump over 440 on rising volume. One way to visualize a surge in volume is with this volume standard deviation indicator down here. You want to look for these big purple bars. That means you're getting a much larger than average move in volume on that day's particular bar. So look for a breakout over 440 on rising volume. All right, that is all for this week. Thanks for tuning in to the Market Mosaic update, and I will catch you again next week.